Hey investor friends, I'm Michelle Markey, and with the stock market still at record highs toward the end of 2021 and likely ringing in the new year 2022 still at these elevated heights, you're probably wondering if we're in a stock market bubble, and so am I. So I've turned to the teachings of billionaire investor Ray Dalio and his hedge fund company Bridgewater Associates to learn what they've had to say about stock market bubbles and what are the signs to see if we're in one or not. So I'm going to share and recap what they've put out throughout 2021. And as always, I greatly appreciate if you can please like and subscribe to my video and YouTube channel because it goes a very long way with the YouTube algorithm, and I greatly appreciate it. Thanks. As you know, in order to stimulate the economy after the events of 2020, the Federal Reserve had to lower the Fed funds rate down to near 0%, and the Fed funds rate influences the interest rate of a bunch of other things such as US Treasury bonds and mortgage rates. And there's a gravity-like relationship between interest rates and stocks. So as interest rate yields go down, then stock market prices tend to go up. And as interest rate yields go up, then stock market prices tend to go down. So it's no wonder we've been skyrocketing toward the moon. And where we are in the stock market is, as Ray Dalio has said, because of
plenty of liquidity and ridiculously low interest rates.
So Ray Dalio and his Bridgewater team have extensively studied bubbles, and in early February 2021, Ray Dalio shared a publication of his bubble indicator system, and he defines a bubble as an unsustainably high price, and he has 6 criteria by which he measures the extent to which stock markets may be in a bubble, and they include how high are prices relative to traditional measures, are prices discounting unsustainable conditions, how many new buyers, i.e. those who weren't previously in the market, have entered the market, how broadly bullish is sentiment, are purchases being financed by high leverage, have buyers made exceptionally extended forward purchases, e.g. built inventory, contracted forward purchases, etc., to speculate or protect themselves against future price gains. And as an update to Ray's observations, Bridgewater Associates in early December 2021 came out with the publication asking, is the air coming out of the bubbles? And is that healthy or ominous? So I'll provide my overview of both of these publications throughout 2021 and what that might be foreshadowing and things to come. And using the 6 bubble criteria, Ray shared a colorful chart comparing current conditions to previous stock market bubbles. And so looking at this, we can see a sea of red across the roaring 1920s and also the .com bubble, and less so in 2007 or the Great Financial Crisis or Great Recession. And then today's market, the total market and emerging tech. And so in order to have more of a quantitative understanding of where we are now compared to the past bubbles, I assigned each of these values a numeric value so that I could calculate how today's conditions are compared to the past. So I gave bubble a numeric value of 4, frothy 3, somewhat frothy 2, and no bubble 1. So when I assigned these values across each of the bubbles here, I got to a 23 for roaring 20s, and then a 24 for .com bubble, and then a 16 for 2007, and then today's total market a 12, but then today's emerging tech a 20. So when we average out today's market and the emerging tech, we get a total of 16, and that's right in line with where we are in 2007. So I can understand why Ray Dalio says that we're halfway there toward having the magnitude of a bubble like we had in 1929 or 2000, based on if we only look at the total market value of around 12, and that's half of what the .com bubble was at 24. But if we include the extent of the emerging tech, we are in way more bubblicious territory. So I think we're a lot closer now than where we might have been in early 2021. And I would like Ray Dalio to update this chart to kind of acknowledge how we're inching ever so slightly closer toward .com bubble territory. And in some other measures like the Shiller price to earnings and the Buffett indicator, we may be hovering really close to the .com level of market overvaluation compared to GDP, let's say. So with all those kinds of indicators, I think that we're starting to have a little bit more red than maybe we have in the past, and even much more than maybe the great financial crisis indicated. And according to Dalio's U.S. stock market bubble gauge, the 1929 and 2000s bubbles were at the 100th percentile, whereas earlier in 2021 came in at around the 80th percentile. And I just did a quick proportional calculation to guesstimate that we might be at the 90th percentile now at the latter part of 2021. And Dalio said that there's been a divergence in these readings where some stocks are in extreme bubbles, especially emerging tech companies, whereas a lot of stocks are not in bubbles. And looking at Dalio's charts of share of market cap in a bubble, if only 2 to 3% of the S&P 500 might be in a bubble, then that might be extrapolated to only 10 to 15 companies. Whereas if we look at the top 1,000 companies, then a higher share might be in a bubble of around 4 to 6%. And of course, all of this is way less than how many companies were in a bubble during the .com era. Moreover, Dalio likes to track the performance of what he considers a basket of bubble stocks, and we can see that this bubble slice has way outperformed the overall S&P 500. And not that I know what these stocks are, but interestingly, they seem to have peaked in their performance in February 2021, and that might be coincidental with Cathie Wood's ARK Innovation ETF, which, not to pick on that, but let's use them as a proxy of maybe some of these stocks could be a similar very growth, innovative companies where when interest rates are low, they tend to do really well. But as the government begins to pull back on all the liquidity, that might not be as much of a fuel to grow further operations. So maybe this could be why the bubble stocks, that some of which could be among those in the ARK ETF, maybe that's why they're pulling back and why the ARK ETF might be down by 39% from its February 2021 highs. And Dalio has said that what's often indicative of a bubble is a rush of new buyers who are attracted by rising prices in the stock market. And this is evidenced by his gauge showing that we're at the 95th percentile. And this is similar to how it was in 1929 and 2000. And it's also been evidenced by other sources, like how there's a bunch of new brokerage accounts that have been open since 2020. And also how there's more website traffic going to a lot of the major brokerage sites. And while sentiment is almost as bullish as it was in the .com bubble, it seems like IPOs and SPACs are just as hot, if not hotter than they were during the .com bubble, as there have already been at least 785 companies that have IPO'd, including through SPACs in 2021 alone. And with U.S. total debt as a percent of GDP being as high as it's ever been, Ray Dalio in June 2021 gave an update of his long-term debt cycle charts in which he showed the overall long-term cycles of U.S. debt as a percent of GDP contrasted with U.S. interest rates and U.S. money supply. And then I superimposed the Dow Jones chart on top of this to try to get an approximation of how stocks performed over some of these cycles. And I saw that how money supply seems to be at a climax now is very similar to how it was in 1946 when it reached a climax, and then the stock market per the Dow Jones index went down from 1946 through 1950 before going up again, and that was also along with rising interest rates. So I feel like we could be in a very similar place as to where we were in the 1940s and 1950s, and maybe stocks might go down as interest rates start going up. And then in December 2021, Bridgewater shared how the unprecedented amount of liquidity has caused their bubble measures to flash red in some pockets of global markets, and they believe there's likely bubbles in areas of emerging tech stocks, cryptos, SPACs, NFTs, and collectibles. And they also think that all bubbles eventually deflate and pop when they run out of the key fuel inflating them, and the timing is generally uncertain. And recent market action is interesting because it raises the question of whether modest Fed tightening could begin deflating these bubbles and whether that would be healthy or ominous. And they also reveal how trading and call option volumes have been declining and how some of the bubbliest segments are down by more than 25% from their peak. So they're starting to signal that maybe some of the bubbliest areas are starting to deflate already. In addition, a significant amount of the market is discounted to grow at a very high rate at like 20% earnings growth for a decade, and that's only to generate normal-ish returns of 8 to 10%. And the last time we had elevated expectations, growth stocks underperformed the rest of the market for the following decade, so that's a little bit of a warning sign to me. All the government stimulus and money printing has led to a lot of liquidity being pumped into the markets, and as Bridgewater notes, this is why equities are especially sensitive to the current liquidity conditions, but they're a lot less sensitive to actual economic growth, so that's why stocks are on the rise in particular. And American households have been seeing an increased wealth effect where when their stocks are going up, they feel like they have more wealth, and that also encourages more of them to spend the gains that they've gotten in the stock market. But then, as Bridgewater warns, as the government begins to withdraw the liquidity through tapering their bond purchases and likely hiking interest rates eventually, then that will lead to rising discount rates and higher risk premiums, which they believe is the lever that will pop the bubbles that they're seeing. And so what this could mean for some retail traders, especially if they've been using leverage, is that they could be forced to liquidate their positions, especially among a wide market sell-off. So that could be some of what could be coming if and when interest rates go up and liquidity starts evaporating out of the markets. And while Ray Dalio says that the current stock market may not be in the highest bubble, and we can't necessarily say that it's even in a bubble, he said that we have to distinguish which stocks are in a bubble compared to the ones that aren't. But I think that Ray summarized it best when he said that
A lot of liquidity, a lot of debt financed debt monetization makes for a classic bubble.
So I hope that was helpful to you, and if you enjoyed this video or learned something, please like and subscribe, and I wish you well on your journey to being prepared as much as possible no matter what happens in the future, and happy investing. Till next time.